Hello, everyone. My name is John Rowland, Barchart's Head of Trading Education. If you're new here, hit the subscribe button to get alerted anytime we upload a new video. Before we jump in, please take a moment to pause the video and read this important disclaimer in full. Any decision to buy, sell, hold, or trade any investment involves risk and are best made on the advice of a qualified financial professional. What's up with the wheat market? Why is it up over 50% since February 24th? And what's behind this parabolic rise in wheat prices? Now, the answer might be simple, the conflict in Europe, but it's a little bit more complicated. What wheat is currently trying to do is discover a new value based on a perceived dynamic shift in the fundamentals of supply. If we look at the world production of wheat, we can see that Russia and Ukraine, according to the USDA, makes up about 15% of world production. But the real statistic that we need to understand is that 15% of production correlates to a 30% of world exports. And if we think that there is going to be a disruption in Ukrainian and Russian wheat, that 30% is a significant amount. So think about this for a second. What if we woke up tomorrow and General Motors closed all of its factories? What would happen to the price of cars? Or better yet, what would happen to the markets that rely on car manufacturing businesses? Well, the world woke up and it realized that maybe Ukraine wheat might be lost. Or at least the spring wheat might never get planted. And with sanctions against Russia, what would happen to that wheat that's available for export? Would we have access to it? And every day the conflict continues is another day closer to turning this perception into reality. So if we look at wheat prices over, let's say, since the beginning of the Ukrainian-Russian conflict, you can see that wheat prices have been up 6 out of the 9 days. Matter of fact, it's had limit days 6 of the 9 days. And if we look at today's price volatility, well, we can see that that price volatility today, we had a low of around $11.63 and a high of $13.63. If we translated that into a dollar value, well, that risk would be about $10,000. Certainly for me and most small retail investors, that is too much risk for us to muster. So how is a long-term investor or a retail investor able to trade the wheat market? Well, we have something called the wheat ETF. And you can see here that our wheat ETF mimics the wheat futures market. And you can see that today we did have a range around $12 on the upside to $10 on the downside, that same $2 price movement. But this is only $2 per share. So if I had 100 shares, that'd be $200 risk. If I had 1,000 shares, $2,000. I would need to have 5,000 shares of this ETF to equate the same dollar value of trading one futures contract. So the question I have for you now is, do you think that wheat prices are going to continue to go higher, or is this just a short-lived rally? Leave me your comments and tell me what you think prices are going to do. But let's look at this from a longer term perspective. And we can see that this ETF is just starting to take off. And if we look at where this ETF topped out back in 2012, and we look at our wheat market and look at the same long-term perspective, 2012, where wheat prices were trading closer to $9, currently we're at $12. Back in 2012, wheat prices rallied based on a weather phenomenon, a drought. Here we're seeing a much more dynamic shift in the fundamentals. And could prices continue to go higher? Well, JP Morgan says that wheat prices could go higher. They're predicting $20 a bushel. And if that happens, well, we'll be paying $20 for a loaf of bread or a dozen bagels. I hope this video was informative. If you enjoyed today's content, make sure you subscribe to our channel and give this video a thumbs up. Until next time, the good of all trading.